Australia AASB 16, Leases, the complete interview-ready masterclass. Hello and welcome to CandiMentor. Today, we decode Australia AASB 16, Leases, the Australian implementation of IFRS 16, applied under the Corporations Act and overseen by ASIC and AASB. If you work in audit, financial reporting, mining, retail, airlines, telecom, banking, or FP&A, AASB 16 will be a key topic in interviews and financial reporting. This is a practical, 2TS-friendly preparation guide. Clear concepts, worked examples, journal entries, and industry use cases you can use to learn and present confidently. What AASB 16 is, the Australian context. AASB 16 mirrors IFRS 16 and removes operating lease off-balance sheet treatment for lessees. Nearly all leases are now on the balance sheet as a right-of-use asset and a lease liability. Australian specifics to keep in mind: heavy property leasing in retail, long mining and equipment leases, aircraft leasing, complex telecom arrangements, and strong ASIC focus on disclosure quality. Anchor line. AASB 16 brings almost every lease onto the balance sheet. Recognize a right-of-use asset and a lease liability. Anchor line. Core model: right-of-use asset, lease liability. At lease commencement, the lessee recognizes lease liability equals present value of future lease payments. Right of use, ROU asset, equals initial lease liability adjusted for prepaid rent, initial direct costs, restoration obligations, and lease incentives. After recognition, ROU asset, depreciated, usually straight line. Lease liability unwinds using the effective interest method. Payments reduce principal. End. Identifying a lease. The control test. A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Control is the customer decides how and for what purpose the asset is used and obtains substantially all economic benefits. In Australia, watch for telecom fiber strands, certain mining equipment, dedicated data center racks. Ask: who decides use and receives benefits? ... Lease term, judgment matters. Lease term equals non-cancelable period plus extension periods that are reasonably certain to be exercised, and exclude termination periods that are reasonably certain to be exercised. Australian examples: retail leases with multiple renewal cycles, mining leases tied to production plans. Reasonably certain requires evidence, business strategy, penalties, market incentives. End. Initial measurement of lease liability. What to include. Include in the present value fixed payments less incentives, variable payments linked to an index or rate, residual value guarantees expected to be paid, amounts probable under purchase/termination options, discount using the lease implicit rate where known. Otherwise, the incremental borrowing rate, IBR. Australian IBR inputs commonly reflect bank margins, government yield curves, and asset/sector risk. End. Initial measurement of ROU asset. Components: ROU asset equals lease liability plus initial direct costs plus restoration provisions plus prepaid payments minus lease incentives received. Example: liability $500K, restoration $40K, initial costs $10K, raw ROU asset $550K. ULF. Subsequent measurement. How balances evolve. Lease liability increases with interest, decreases with payments, remeasured for term or payment changes. ROU asset depreciated over the shorter of asset useful life or lease term. Test for impairment under AASB 136. Common triggers for remeasurement in Australia: CPI rent uplifts, exercised options, restructuring, store closures, mining site changes. Auth. Journal entries, core flows. At commencement, full debit, ROU asset, credit, lease liability. Each period, interest. Full debit, interest expense, credit, lease liability. Lease payment, full debit, lease liability, credit, cash. Depreciation, full debit, depreciation expense, credit, accumulated depreciation, ROU asset. Memorize these for interviews and case walkthroughs. Short-term and low-value exemptions. Lessee accounting exemptions can be elected. Short-term leases, less than 12 months with no purchase option, expense as incurred. Low-value assets, example, small office items, may be expensed. Australia uses these widely for laptops, small printers, portable tools. But be cautious. Cars and heavy equipment generally aren't low value. On. Variable payments, index versus performance. Index link, e.g. CPI, included in liability. Use index at remeasurement points. Usage or sales-based, expensed as incurred, not included in liability. Common Australian examples: turnover rent in retail, variable, expensed, versus CPI escalations in commercial leases, included. Lease modifications. A high judgment area. A modification changes scope or price. If it adds a separate ROU asset at standalone pricing, account as a new lease. Otherwise, remeasure the liability and adjust the ROU asset. Australian examples. A retailer adds or reduces floor area. Minors extend equipment scope. Use the assessment flow. Is the added right distinct and separately priced? End. Remeasurements. Common triggers remeasure when index or rate changes for indexed payments. Lease term changes because options are exercised or no longer reasonably certain. A modification changes payments or scope. When remeasuring, update the liability and adjust the ROU asset, or recognize gain-loss if ROU asset is reduced to zero. End. Embedded leases identify within service contracts. Service contracts can contain embedded leases. Common Australian industries with embedded leases: power purchase and facility contracts, drilling and contract mining, freight, logistics service agreements, data center rack or dark fiber hosting. If a supplier controls substitution and economic benefits, it may not be a lease. Otherwise, treat the right to specified asset control as a lease. Sale-and-leaseback. Apply AASB 15, then AASB 16. If a sale occurs under revenue rules, recognize only the gain related to rights transferred and account for the leaseback as a lease. If no sale, treat the transaction as a financing. Common Australian examples: property sale and leasebacks by retailers, equipment sale and leasebacks in mining. Financial statement impacts. What moves income statement? Depreciation plus interest replace straight rent. Often front-loaded expense profile. EBITDA typically increases. Balance sheet, assets and liabilities increase. Leverage metrics change. Cash flow, principal, financing. Interest, operating or financing depending on policy. Operating cash flow can increase. Interviewable line. EBITDA rises because rental expense is replaced by depreciation and interest. End. Disclosures. ASIC emphasis. Disclosures must include maturity analysis of lease liabilities, ROU asset roll forwards and classes, expense for short-term and low-value leases, variable payment expense, remeasurement and modification impacts, discount rates and policy choices. ASIC frequently reviews these disclosures for clarity and completeness. Industry scenarios. Pick one in interviews: retail, mall leases, turnover rent, store closures and impairments. Mining, heavy equipment leases, site restoration costs included in ROU asset. Airlines, aircraft and engine operating leases, fleet restructuring. Telecoms, tower leases, dark fiber, embedded hosting leases. Logistics, vehicle fleets, warehouse leases, per-use equipment charges. Use a local example and walk the 5-step thought process. Identify lease, measure liability, recognize asset, subsequent accounting, disclosure. Numerical example, tidy and interview ready. Annual payments $100,000 for 3 years. IBR 5%. PV factor approximately 2.723. Lease liability approximately $272,300. Journal at commencement. Full debit. ROU asset $272,300. Credit. Lease liability $272,300. Explain. Interest unwinds. Payments reduce liability. Asset depreciates over lease term. End. Common interview questions. Crisp answers to practice. How do you identify a lease within a service agreement? What is included in the ROU asset at commencement? When do you remeasure the lease liability? How do variable payments affect profit and balance sheet? Why does EBITDA typically rise under AASB 16? Answer each with a short example and the core accounting line. That's it. Final wrap. Concise strategies for interviews. Start with the identification test. Identified asset plus control. Explain initial measurement. Liability PV. ROU components. Describe subsequent patterns. Interest, depreciation, remeasurements. Use a local industry example and a small numeric walkthrough. Close with disclosure and governance points. If you learned something today, subscribe to CandiMentor. We're building a practical learning hub for accounting, finance, and interviews, and you should be part of it.